Hello and good afternoon, everyone. Thank you for joining our webinar today on the Employee Retention Tax Credit. We'll be starting in just a few minutes. Hello, everyone. Thank you for joining our webinar today on the Employee Retention Tax Credit. We'll be getting started in just about 1 minute. Good afternoon, everyone. Thank you so much for joining our webinar today on the Employee Retention Tax Credit. We're excited to have you here, and this presentation does qualify for CPE, so please watch and respond to the polling questions that you will see throughout the program. You must respond to those questions to qualify for CPE credit. So thank you again for joining our webinar this afternoon, and I will turn it over to Jonna Kelly to get us started.
Hello, everybody. I'm Jonna Kelly, and I'm going to talk with you today a little bit about the very important Employee Retention Tax Credit. Before we start, I want to point out that there's been quite a bit of guidance and changes related to the Employee Retention Tax Credit, and therefore you want to be sure to take some time to use your own judgment and interpretations, and of course reach out to your CPA for further information if you ever find anything a little bit confusing. We've got an agenda today that will start with affiliate rules. We'll talk about eligible employers, including small versus large employers. Eligibility test, whether it be the revenue test or the full or partial closure test. How to calculate the ERC, including how to figure out what a qualified wage is and related party issues. Interaction with other credits and PPP loans. And finally, how do you actually claim the employee retention credit once you've determined the amount of credit due to you? So let's talk about a brief history. A lot has changed since March 27th, when the CARES Act first introduced the employee retention credit, which is a refundable credit against the employer's share of Social Security tax. Late in the year, in December 27th, 2020, a lot of PPP borrowers got a big Christmas present, in that the CAA made the ERC available to PPP borrowers. So many people who had decided that they weren't really going to learn much about the ERC or potentially claim it, later learned that they were eligible and have been doing a lot of scrambling around to go back and claim the credit for different quarters of 2020. That same act also prospectively, so going forward, extended the credit at that time just to June 30th, 2021. Then on March 1st, a notice provided some rules about qualified wages. And on March 11th, the ARP Act extended the employee retention credit to the end of 2021. And then very recently, we received an advanced version of Notice 2021-23, which expanded some of the guidance. We're going to talk about all of these things as we go through, but you can see there's been quite a bit of changes over time. So we'll start with affiliate rules. Often when I'm talking with a borrower or potential employer for the employee retention credit, we start here because it's a little known piece that needs to be thoroughly looked over, and that is, what are your affiliated parties? Unfortunately, the employee retention credit requires that you consider all affiliated parties when you do various things, such as determine how many employees you have, the full-time equivalents in 2019. That is the way you decide whether you're large or small. It is also how you determine the decline in gross receipts. So you may find in one entity you have a gross receipt reduction, but in another entity, perhaps you have an increase. And those two things may be work at cross purposes for you being eligible for the employee retention credit. It also impacts the maximum credit per employee. So an employee among affiliated entities that's limited to $10,000 of qualified wages, that would be across all affiliates. There's quite a bit of guidance. This is a lot to read, but I think it's important to take a look at exactly how the affiliate rules work without getting too into the weeds and with the time constraints that we have right now. One of the things that I wanted to point out here is that this works a lot like the 163J affiliate rules. The parent, subsidiary, brother, sister, combined group rules are very well defined in the guidance. If you find that you're having a little bit of trouble determining if they impact you, I would strongly recommend you reach out to your attorney or CPA to take a look at that before you proceed. And the reason I feel so strongly about this is because PPP was administered through the SBA, but the employee retention credit is going through the IRS, and affiliate rules are something that they have a lot of tax code and guidance on that you're going to want to take into consideration if down the road you ever are subject to any kind of audit of the credit. So eligible businesses, obviously it has to be a business. So the employer needs to be really in the business, just as we normally define trade or business, the intention of making a profit, conducted on a regular, continuous, and substantial basis. A household employer would not be considered someone conducting a trade or business, so you cannot claim the employee retention credit for a household employee. Self-employed individuals are not eligible for the employee retention credit, but if a self-employed individual has employees, they may want to request the credit on their employee basis. And a tax-exempt organization is deemed to engage in a trade or business with respect of all operations. So that's important to note. And then in 2021, the ERC was expanded to include colleges and universities and entities whose principal purpose is providing hospital or medical care. So you can see the intention in that late guidance to assist perhaps entities that are helping during a time of pandemic. So small versus large employees. This is an important employee count. It does work a little bit differently than PPP. So for all of the PPP borrowers out there who have struggled through the FTE calculation, we know that that was based on 40 hours and that there was certain time constraints like reference periods and covered periods where you would be making those calculations. For the employee retention credit, you look back to the year 2019, and we're using a little bit different measurement here. So for purposes of the employee retention credit, a full-time employee is defined as someone that has at least 30 hours per week or 130 hours per month. And that's important to remember, not only because it's different, but because you're going to want to, as part of your employee retention credit claim, you're going to want to have actually done that credit, especially if you're anywhere in 2020 close to the 100 FTE mark, or in 2021, the 500 FTEs. Either way, you're going to want to make sure you do that credit. And do remember also that that would be including all affiliates. So you'll have to combine all of your affiliated entities when making that calculation. So why does that matter? Well, it matters a lot because the large employers are not allowed to take credit on wages for their employees as in the same way that a small employer does. So for instance, a large employer is only going to be able to claim the credit on employees that they paid who were not working. So think about a situation where perhaps a restaurant sent all of their workers home because they had to be closed for a certain amount of time, but they wanted to pay those employees because they're valued employees and they wanted to help. And so those employees were still being paid, but they weren't providing any services. They weren't actually doing anything. That's the type of wages that a large employer can claim. A small employer can claim all of the wages that they're paying. Also, in the allocable health plan expenses for large employers, let's take a look, include the health plan expenses for employers who are laid off or furloughed with no pay, but the employer keeps paying the health care. But you do have to exclude the health plan costs that are during the period of time where the employee is providing services. So again, it all revolves around whether or not services are provided. Some other exclusions, pre-existing PTO that they're taking, that's not considered a wage that you're paying them because that's considered to have been accrued in advance. Severance, we'll see that wages for some of the other credits are pretty much always excluded. Medical leave taken, and of course the employer payroll tax. So let's start looking at eligibility. We're going to start with talking about the full or partial suspension rules. These can be a little bit tricky to follow. You don't have to be completely suspended. It can even be a partial suspension. And a partial suspension is defined as an employer not able to continue operations in a manner comparable to the operations before COVID. So it's not a supply concept. I mean, it is a supply concept. It is not a demand. So if the demand for your business is lower, that's not really a partial suspension. It's more meeting the supply need. If you're able to telework, that's not considered a suspension. And one really important thing to point out here is that the words more than nominal effect were defined. So that was even quantified where the Notice 2021-20 defined that as being at least a 10% of total gross receipts in 2019 based on hours of service performed by employees or by gross receipts. So how does that actually work? Well, think of a restaurant that perhaps has in-room dining and drive-through. If they're no longer allowed to have in-room dining and they maybe put everything to drive-through, but maybe they make more money than they made before, but their in-room dining represented more than 10% of their normal gross receipts in 2019, then that would be considered to have a more than nominal effect on their business. Let's talk about government order. That's a pretty specific phrase. It would be an order from a city mayor requiring the non-essential businesses to close. Another example might be a state emergency proclamation or an order from a local official that imposes some kind of curfew. Perhaps a grocery store had to be closed at 10 and used to be open 24 hours. An order from a local health department mandating workplace closure. Notice that in all of these examples, it's a requirement. It's not a choice on the part of the employer. Statements or comments that are made by a government official in a press conference or a media interview, that's not considered a government order. Here's a few examples that we can talk through. Example one, a car dealership is open, but because there's a stay-at-home order, sales plummet. That's not really by itself a full or partial suspension. Now they could be eligible for the ERC for revenue, but it's not going to meet the full or partial suspension requirement. We have the full or partial example for the in-room dining that we've already discussed. And also example three, a software employer's office space is closed due to a government order and all the employees are teleworking. That's not a full or partial suspension because their business continues. And then in example four, a grocery store is required to reduce its operating hours from 24 hours to 18 hours by the local mayor. That would be considered a partial suspension. Employers that qualify under the suspension, this is important to remember, they're limited to the wages only during that suspension. So someone that's going to claim the employee retention credit based on those rules will want to keep documentation of those orders when they began and when they end, and only during that time frame. So it's not on a quarterly basis anymore. Only during that time frame are they going to be eligible for the employee retention credit. So what if you can't meet the full or partial closure rules? Well, you could meet the eligibility through a reduction in gross receipts. So let's define what gross receipts means. First, we're going to talk about for the for-profit entity, that would be your sales, less any returns and allowances, plus investment income, interest, dividends, rents, royalties, annuities, and less the adjusted basis in assets sold. A not-for-profit is also eligible, so let's define that for the nonprofit space. Again, it's the total sales related to all activities, but it also includes among the investment and other income, contributions, gifts, grants, member dues. Keep in mind that when we talk about this gross receipt decline, that it doesn't have to necessarily be COVID related. You don't have to prove that your decline, although it likely is related to the coronavirus. So the neat thing about the significant decline in gross receipts is that you're actually eligible for the entire quarter and through the end of the quarter where you get back to your 80% of prior year. So I've got a couple examples here. In this first one on the left, we see that when we look at the 4 quarters of the year, we can see that the client would be, the employer would be eligible during Q2 and Q3 clearly, but they're also going to get to take the credit in Q4 because they get to take it through the quarter following. So it's at the end of December that they become ineligible or have to retest their eligibility. In the second example on the right, you'll notice that only in Q2 did they show eligibility. In Q3 and Q4, they're above the normal requirement. So they're eligible from Q2 through Q3 in that example. So in 2020, the reduction in gross receipts needs to be 50%. That's a pretty high hurdle to get over. In 2021, which this is where we are now, of course, the significant decline is now reduced to 20%. Employers can make an election to use a prior quarter. We'll talk about how that's going to work. So there's 2 ways to meet the reduction in gross receipts in 2021. So let's look at each quarter very specifically and individually. For Q1 in 2021, an employer is eligible if they can substantiate a 20% or more gross revenue reduction for Q1 2021 versus Q1 of 2019. So we're comparing this quarter that we just finished to the pre-pandemic quarter in 2019. That is the exact same quarter. Or, as I said above, you can make this election to use the prior quarter. So you would go back 1 quarter, Q4 2020, and compare it to the same quarter of 2019, which you would have technically done as you were just testing your eligibility for 2020, but you would have been looking for a 50% reduction for that year. Now for 2021, you're only looking for a 20% reduction. And then in Q2, you could substantiate the gross receipts test by showing the 20% reduction of 2021 Q2 to 2019 Q2, or again, going back 1 quarter, Q1 of 2021 to Q1 of 2019. What's a qualified wage? Once you determine that you're eligible, you've tested your affiliates, you've determined you're a small versus large employer, you've determined which time periods that you're technically eligible, you're going to decide what are the wages that I get to claim. Because we're going to take, in 2020, we would say that you would have $10,000 annually per employee. In 2021, of course, as many of us already know, it's $10,000 quarterly. We'll talk about that again. But what you can't count in the qualified wages are the following: any PPP wages or healthcare costs that you have been using for forgiveness. So for those of you that have already filed for forgiveness and PPP for the first draw, you're kind of locked in to those numbers. And we'll talk about how that works a little more in a future slide. If you claimed any FFCRA or family medical leave credits, you can't use those for ERC. So just think about not double dipping. Work opportunity credits, research and development credits, wages paid to a related employee that are more than a 50% owner, related to a more than 50% owner cannot be claimed. So generally the idea to remember here as you go through these is to not double dip. If there's an alternative source for the credit, you certainly can't do that. And then there's some specific related party rules that we're going to look at as well. In 2020, so the credit is going to be 50% of those wages. The wages are maxed at $10,000. So someone that makes $10,000, you can have a credit on that employee of $5,000. If they make $8,000, your credit's going to be $4,000. If they make $12,000, your credit's going to still be limited to $5,000 because of the $10,000 limit. Technically, the employee retention credit became available on March 13th. So any wages from March 13th to the end of the year, we're just talking about 2020 right now. And again, it's $10,000 per year and a max credit of $5,000 per employee. Keep in mind that there's always some rules about the small versus large employer. So again, if you're a small employer in 2020, that's 100 or fewer, then you get to count all of the wages plus the healthcare costs that are paid by the employer. Not all of those other credits. You obviously can't count your PPP wages or other credits, but all the other wages in healthcare that you paid, if you're under 100 employee or equal to 100 employee, you can use those wages. But the minute you have more than 100 employees, remember that's based on 2019 numbers, not today's numbers. You're going to have to go do a look back. Then you can only claim the wages for employees that are not performing services while the government order was in place, or you had that decline in gross receipts. And again, you can't double dip on credits, and you have to really be pretty careful about how you calculate that. Okay, so in 2021, how did the wages work? Again, it's pretty much the same, except for that now the qualified wages per employee is increased to $10,000 per quarter rather than $10,000 per year. And the credit calculation increased from 50% to 70%. So it's a much bigger credit in 2021. In addition, in 2020, you were limited to the amount of wages you paid on a 30-day look back. So in other words, in 2020, they had a special rule that kept you from overpaying people during 2020 to try to increase your credit. That was eliminated for 2021. Related parties is an important area to consider. If you have a more than 50% owner, you do need to look through your employee list and look for children, brothers, sisters, parents, step-parents, nieces, nephews, aunts, uncles, in-laws. All of those people are considered related, and you cannot claim their wages for the employee retention credit. This could really impact the C Corp or the S Corp shareholder, and that's certainly relevant for quite a few people in this space. For other entities, a related individual includes a person having a relationship of more than 50% interest in the capital and profits of the entity. So here's an example for 2020. Let's look at some real numbers here. A restaurant has less than 100 FTEs, so they're a small employer. And we have a little graphic here that shows all the wages, and they're all considered qualified wages. So we don't have to worry about PPP or other credits. And due to a government order, they were partially suspended from April 6th to May 31st. So just a small time frame. Maybe the restaurant had to be closed during that time, and they pay 60% of the wages and 100% of health premiums. So you've got a couple employees here, and you see their weekly gross pay, and we've got what their wages are from that time frame. So during our partial suspension, but the employer is only going to pay 60%. So they normally would make what's in column B, but they actually are only going to make 60%. They have their health insurance payments. So the qualified wages and the health insurance is totaled in column E. We limit everybody to 10,000. We take 50%. That for those two employees, that employer could claim a credit of 9,200. So this is a similar example. This time though, the restaurant has a 60% decline in gross receipts for Q2. And so we're going to take a look at this one, and you'll see a little bit about how the revenue reduction works differently. So you've got your weekly gross pay, same situation, paying 60% of wages in Q2. Then when they get to Q3, maybe things are looking a little better. So they're paying 100% of wages, still have their health insurance for all of those quarters. And so the qualified wages and health insurance total to fairly large numbers, but again, limited to 10,000. So the total credit in that situation is 10,000 for both employees. Example 3, still a 2020 example. But some of the services that are provided are considered qualified. The government order has them partially shut down, similar to the first example. They're only working 60% of the time, but this time this is a large employer. So let's see how that works differently. So in column A, you've got the wages, right? And they're working 60%, but we're continuing to pay them even for the 40% that they're not working. So in column C, you see the portion we're paying them to not work. That means their qualified wages or $16,000. Now we're also going to give them 40% of the health insurance. So we've got our column E. That totals to column F, but again, we've got a limit. So in this case, they are limited to 10,000. And the relevant part of this is that they were only allowed to take the qualified wages for when they were not working because they were a large employer. All right, so let's move on to 2021 because that's really where we are now. And I know there's a lot of questions regarding how it works. The small versus large employer threshold became much easier. So now in this example 1, we have a restaurant that has less than 500 FTEs, and that's considered small now. All wages are qualified, so we're going to ignore the PPP and other credits. They're partially suspended from January 1st to June 30th, and they're paying 100% of all of the wages. So you've got Q1 wages and health insurance. And again, a limit, that's just for quarter 1. So for quarter 1 only, this particular employer gets a $3,265 credit. So to continue, that was just Q1. Now we're still talking about the same employer. Now we have Q2 wages to consider, health insurance, or limits, and so forth. So you can see where this credit grows very quickly in 2021 as compared to 2020 because of the increased amount of qualified wages that are permitted. So here's a little comparison. The 2021, that top row, the applicable period, it's technically through 12/31/2021 now, but we don't actually have guidance about how the next 2 quarters work, and we'll talk about that in a minute. So for the purposes of discussion today, we're going to limit it to just through June 30th. The maximum wages went from 10,000 annually to 10,000 quarterly. The ratio went up. The large employer threshold went up. The gross receipt threshold went down, making it easier to get, and the max credit obviously also went up. So the 2020 example we have here has an eligible quarter in Q2, Q3, and Q4. They're a small employer. They paid different wages to each of these 4 employees, A, B, C, and D, for those 3 quarters. And you can see the different wages. So in Q2, they had 24,000 of qualified wages, if we sum those up. And employee B is topping out on their 10,000 the very first quarter. So they're limited, and the rest of the quarters are going to not be able to be counted. But the credit for the Q2 would be calculated with those wages. Then in Q3, the employee A gets about 2,000 more of wages. So now he's topped out. Employee C is at 8,000, so he still has a little bit of wiggle room. And then employee D has 4,000, so they've got some space there as well. All told, when you limit each person in 2020, the credit would be 36. Well, the credit is 50% of the 36,000 or 18,000. Now look at a similar situation in 2021. Because the credit restarts each quarter, there is a potential credit here in a very similar example that is $32,900, and it's much larger because this really illustrates the increased amount of eligible wages per quarter. All right, so PPP forgiveness is, of course, also on everyone's mind at the moment because it's a time when many borrowers are applying. My recommendation would be, if you have not applied for PPP forgiveness, it's time to slow that project down a little bit so that you can claim, if you're eligible in 2020, you can maximize PPP forgiveness and employee retention credit. So while many of the borrowers that we work with, and you can see a little snip of a PPP forgiveness application right here, would have gone straight payroll. So you see on line 1, I have an amount, but we're not claiming any mortgage interest, rent, utilities on the other lines. And that was the common convention for 2020 because there was no ERC eligibility. In this situation, because this borrower, if they have already applied for forgiveness, they're now locked into those wages, they would be limited to their PPP loan amount. Those wages that equal the PPP loan amount would have to be allocated to PPP, and you could not use them for employee retention credit. If this same borrower had reduced their covered period and had considered only 60% threshold of the payroll cost for the, in comparison to the entire loan, they probably could have still gotten full forgiveness, but allocated a little bit more for the employee retention credit. Here's a couple of examples that in this sort of situation that I think are important to talk about. And these are from the IRS website, so obviously they're kind of wordy. But even if I could just give you a synopsis. In example 1, the application was submitted. So that's the problem. You've already submitted the application, so you're kind of locked in. And the application reports 100,000 of qualified wages, and their loan amount is 100,000. So this particular borrower would be stuck with that 100,000 of PPP forgiveness wages that cannot be used for ERC. But in example 2, employer B received a PPP loan of 200,000, and they paid 250,000 towards their wages. And so when they went to apply for forgiveness, they reported, their total wages on there. And so they submitted their application and reported just straight wages, no non-payroll. Well, they overshot, right? So they had $250,000 of wages, but just $200,000 of PPP loan. In that situation, the employer is deemed to have made an election that they cannot use $200,000 towards the ERC. So that's good news, because even though they showed $250,000 on the application, they only have to use what's actually up to the loan amount. In example 3, we've got a PPP loan of $200,000 again. They've got $200,000 of qualified wages. They also have some other expenses, $70,000 of the non-payroll expenses. And so when they submitted their application, they did not report the other expenses of $70,000. In that situation, the employer is deemed to have made an election not to take into account, again, $200,000 of wages. But in example 4, if we take that same example and tweak it just a little bit, they reported the $200,000 of wages and $70,000 of eligible expenses. So they had a $200,000 loan. They came up with $200,000 of wages and $70,000 of other expenses. They actually get a little bit of a allocation in that situation. So notice the last paragraph says that in that case, they're deemed to have made an election not to account for $130,000 of the qualified wages. So even though they put $200,000 on there, because they had the other 70, they get to count only $130,000 away towards PPP and not utilized for ERC. Now, I want to pause really quick and just say that a lot of people think that this is still not exactly fair to a borrower that maybe has already submitted forgiveness. And there is a little bit of pushback to maybe change some of this, but this is at the moment the current position. So PPP2, so we're in 2021. PPP2 is extended to May 31st. So a lot of people are now thinking about applying for that. A lot of times when you're eligible for PPP2, you're also eligible for the employee retention credit because the thresholds are fairly close, 25% for PPP2, 20% for ERC. One thing that we often suggest to our borrowers is if you are going to apply for that, try to get that application and those funds dispersed to you at the last minute. So use as much time as you can for the employee retention credit. PPP funds are better than ERC because they're more dollar for dollar, whereas the ERC is always 50% or 70% of wages. So we don't want to hurt PPP election, but we also want to maximize any available credits in those situations, which can take a bit of analysis. All right, so how do you claim it? You've figured out whether you're affiliated, you've figured out if you're a small or large, you've calculated, now what do you do? So you can access the employee retention credit for the first and second quarters of this year before filing your employment tax return, but it's in certain situations. You could do that though right out of the gate by just reducing your tax deposits. Now be careful with that. You need to be fairly confident that you are eligible and that you've calculated the credit accurately. But you could just stop paying some of those payroll liabilities. And then the difference would be all you'd be asking for on your Form 941s. We'll talk about that a bit in a minute. If you're a small employer, you can ask for an advance payment, but only after you reduce those payroll deposits. So, and there's some limits. In 2021, small employers can request an advance that is equal to or less than 70% of their average quarterly wages paid in 2019. So you'd look at line 5C on the Form 941. Large employers are not allowed in 2021 to ask for an advance anymore. There are some special rules. So I know there's always those situations where maybe a business was in existence. That's a little bit beyond the scope of today, but there are some rules in place for that type of situation and even for seasonal employers. There are no special rules for claiming the credit for employees who just came into existence this year. So it is assumed, therefore, that there's no, those cases, no advance is permitted to those type of employers. The ARP Act now gives the IRS, and I think this is really important, 5 years from the tax filing date to audit the credits. It used to be 3 years. So I think it's important to remember that that extension of time is not an accident. The IRS is now making it possible for them to go back for the next 5 years and look at your claim for a credit. So it's really important to create a really good package, really good story of what exactly happened, so that in 5 years, if you don't really exactly remember how you came up with those numbers, that you have a good, trail to give to the IRS. And lastly, this is important, the CARES Act way back in March of 2020 provided a waiver of penalties for failure to deposit employment taxes if the failure was due to a reasonable expectation of the ERC. So keyword probably there is reasonable. This is a picture of the 941, and I know it's kind of small. I don't really need everybody to be able to read it. What I really want to show here is all of the highlighted lines are new based on new credits because of the pandemic. So the reason I'm bringing that up is if you have any experience with filing Form 941s, you have already noticed they're really different. There's also a worksheet. We'll show you a little picture of that on the next slide. But learning how to navigate that if you do your own payroll can be a bit tricky. The payroll providers, of course, they're trying to get up to speed as well. This is a 7200. This is the advance. This is the claiming of the advance. Once you claim it, then there's a section on the Form 941 where you say, okay, I should have gotten $500,000 credit. I claimed 500,000. Now I've run the numbers and it turned out it was 600,000. You owe me another 100,000. It's kind of similar to what we all do on a 1040. This is what I earned. This is what I've already paid in. Do I owe you or do you owe me? And it's a very similar process. So this is a little bit closer look at the Form 941, and this is an actual example of a form that has been created to claim the employee retention credit. And you'll see I've got it kind of highlighted down there at the bottom. So it looks pretty much the same all the way through. There's some qualified sick leave and family leave that wasn't applicable to this particular employer. But at the bottom, you'll see there's a non-refundable portion. So that's against the Social Security tax. And then on the next page, sorry about that, the next page on page 2 is the refundable portion. So in this case, the borrower's total amount is in two separate places, the refundable and the non-refundable. So that number that we talked about earlier that we're calculating when you file this form, you have to go through a few steps on the worksheet to figure out which part goes where. And I've highlighted at the very bottom, see the overpayment on line 15 is $13,727. So because of this credit, this particular employer has overpaid payroll tax. And you have options. You can either apply it to the next year's return, or in this case, the employer chose to request a refund. We don't know how quickly those refunds will be given to the employer. There's very little data right now on how quickly the IRS will be able to turn that around, but I think we all know they're fairly covered up at the moment. Under a special rule, employers can treat the 2020 qualified wages as all taking place in the fourth quarter. So if you're doing that retroactive, or maybe you haven't filed Q4 yet, either you have to amend or you're going to go back and do the Q4 2020 payroll report. Instead of having to do an amendment for each quarter, let's say you're eligible from quarter 2 all the way to the end of the year, you can push it all into quarter 4, which makes the situation just a little bit simpler for 2020. Other issues to consider, this credit is not considered federal taxable income. The compliance among states varies and is probably going to change over time. Current guidance says that deductible wages during a tax year have to be reduced by the amount of credit. So if I'm putting together a 2020 amended 941 in order to claim a credit, maybe I've pushed it all into quarter 4 like we just talked about, and I think my credit should be $100,000. Then I have to reduce my deductible wages by $100,000 with OSH in 2020. So that obviously increases that particular taxpayer's net income in 2020, and they haven't actually received the credit, the actual cash. It's a great credit, but that means that you do want to consider that the net benefit is going to be reduced by the marginal tax rate. We don't exactly know if this is going to have a big impact on 199A. That's an issue that is fairly open and still on discussion. It could also have an impact on any kind of wages that are capitalized, and therefore depreciation expense should be considered. So there's a few moving parts. And lastly, probably the most important thing is that the most recent statement or notice that we got from the IRS only discussed items through June 30th. Now, we already know that the credit continues all the way to December 31st, but at the moment, we don't know how Q3 and Q4 might work. For instance, that alternate option of going and looking at the prior quarter, will that work the same? Will it be different? What other changes might take place? But we do know at least through June 30th. So hopefully we'll get the rest of that guidance before were actually in Q3 and Q4. One other little small side note is there is an additional some new guidance related to severely financially distressed employers. So we're going to call them SFDEs. And the Consolidation Appropriations Act added a category of this type of employer to the guidance. And basically the way it works is an employer whose gross receipts for the quarter are less than 10% of the gross receipts for the same quarter of 2019. So that's a 90% reduction. And there is that very likely situation, particularly in certain industries. They're considered an SFDE. And in that case, no matter how many employees they have, they are allowed to take the credit whether people are working or not. So this would be particularly helpful. So remember that PPP has a limit to how many employees you can have. ERC doesn't have a limit as to how many employees you can have. It just defines you as small versus large. So in 2020, if you determine that you're an SFDE for a particular quarter, and you had 700 employees, you might be thinking normally you can only take the credit on employees that you are paying to not work. But in this situation, you can take the credit on all employees. By the way, the effective date is July 1st, 2021. So this suggests that this is only eligible for the second 2 quarters of 2021. So lastly, just briefly, accounting for the employee retention credit, very similar to accounting for PPP. If you believe that the requirements to receive the credit have been met and you've taken the appropriate steps to claim the credit, you can recognize as an item of other income. One thing you definitely don't want to do is net the credit against wage expense on the financial statements. So with that, I think we've used up pretty much all of our time. I wanted you to know that we are collecting the questions that have been asked in the Q&A, and so we will create responses and send those out to attendees. In addition, you're welcome to email me at jonna.kelly@bbccpa.com. And I also have my QR code up there for LinkedIn if you want to reach out in that manner. Appreciate everybody coming. I know this is an important time to try to understand this credit and that it certainly has changed quite a bit. We'll continue to provide webinars on the subject as things change, but this is our information to date and we hope we found it helpful. Thanks.
Hi, Jonna. Hi, Jonna. So we actually do have some questions and we have a few minutes.
Okay.
So do you want to open up the Q&A box and see if there's a couple in there that could be answered pretty quickly? Yeah.
So I have one question that says, can you choose a different gross receipts test for each quarter? So the threshold has to stay the same. I'm not sure if that makes sense, you know, what I'm saying here based on the question, but the threshold, for instance, in 2020, gross receipts needs to be a 50% or more reduction. 2021, it needs to be 20% or more reduction, but you would measure it on a quarter by quarter basis. I hope that helps. If you had 3 locations but had to close 2, do you compare gross receipts for 2021 with the location still open? So, okay, so this is a good question because it brings up the affiliate issue. One of the things I probably didn't spend enough time on that might be helpful, once you meet the affiliate test, so if you've got 3 locations and maybe you have, you know, they're all grouped together because they're all affiliated entities. If one of your affiliates meets the full or partial closure test, then all of the affiliates meet the full or partial closure test. So while sometimes it seems like the affiliate rules are not working in an employer's favor, sometimes they would. But still, you're going to compare gross receipts on an affiliated basis. So you will not look at just a particular location, you'll look at all locations together. All right. Oh, if you didn't take the PPP, yes, you can still get the employee retention credit, whether you took a PPP loan or not. I think what changed was that PPP borrowers at first were not allowed, but everyone has been permitted to take the employee retention credit starting on March 13th of 2020. Okay, I applied for PPP forgiveness in Q3 of 2020. I became eligible in Q4. In this case, all of my wages for Q4 are ERC eligible. Is that correct? Yes, that's correct. Very good news. If your forgiveness covered period, it's not really when you applied it, but let me make sure we're on the same page. If the covered period ended at some point in Q3 and it doesn't stretch into Q4, then you don't have to worry about it. So to elaborate, if you had a spreadsheet with all your employees going down rows and across the columns, every single paycheck, and you maybe chunked out this piece, this all went to PPP. Once that covered period is over, everything beyond on either side, frankly, could be eligible for the employee retention credit based on your eligibility timeframe. So you want to figure out the timeframe you're eligible, you carve out the PPP and you see what's left. I hope that helps answer that question. Oh, I'm sorry if this was addressed, but if you are claiming up to the maximum 100,000 of salary in PPP and 197,300 for HHS provider relief fund, can any excess of be continued? Yes, any excess above. So that's a very good question. Let's say we'll make it a little simpler. If you had, the limit of the PPP 100,000, so you could only allocate $8,333 per month for PPP, but you actually paid that person $30,000. The rest, that difference, can go towards ERC. In your case, you have two things to carve out, and it's very wise to do so. Anything that's paid by some other grant or funding, obviously you shouldn't double dip, but beyond that, you certainly can answer yes to that question. You can use the rest for ERC. If you're claiming for 2020, do you file a 941X? Yes, that would be your option at this point, is a 941X. So what are the nuts and bolts of that? This is how I would do it. I would take the 941 and look at what you filed. And then I would recreate the 941 so that you have the employee retention credit on the way you should have filed. And then you'll take the 941X and it's really just like I just mirrored it. This is what I did. This is what I should have done. Here's the difference. That results in hopefully a refund to you. So how would the ERC work when there are two or more companies that pay their employees through the same separate entity? I think I understand this question. When you've got more than one company and it's, the 941s are tied to EINs, you still have to measure your eligibility on an affiliated basis, but you're actually asking for the credit on an individual basis. So, and be careful, any employees that are like in both places, you'll want to watch out for that. If you haven't claimed the credit in Q4 of 2020, it's not too late. You can file an amended 941. There's really no time frame. There's no urgency to do that. So some of the people I work with are saying, I'm going to work on Q1 of 2021 to try to get that one on time so I don't have to amend it. And then they're going back and amending their Form 941 for 2020 or whatever quarter. By the way, let me bring up one little thing that just came to mind. Payroll providers are working diligently to try to get up to speed on this. I'll admit that I'm not sure that they are. There's still a little bit of confusion, just like there was early on in PPP, but they are doing their best. If you work through a payroll provider such as ADP, Paychex, Gusto, or whomever, just remember that a lot of times the contract you have with them will be considered null and void if you go and file your own Form 941X, an amended report. So if you use a payroll provider, you definitely want to reach out to them. They will probably ask you to tell them what the credit is. And interestingly enough, I talked with an employer today. They're expecting a very large, over $2 million credit in Q1 of 2021. Initially, their payroll provider said they would do it for them, would calculate it for them for 10%. And when they pushed back a little bit, that same payroll provider can reduce their fees heavily in order to get something out of the deal. So we're finding that some of those aggressive payroll providers that were, offering to take just a small percentage of your $2 million credit are now changing their fee structure based on clients not being particularly happy with that high number. So briefly, and I think I'll probably end with this, the accounting treatment of the credits. So if you think that you have done everything for, let's say, 2020 and that you're eligible to get the credit and you've applied, maybe you've already done it. You applied on your Form 940 for Q4 of 2020 and you think you're eligible, then you can count that as an income, an item of income in 2020. I would obviously call it an other income. It's not your normal revenue. It's not going to be taxable for, tax purposes. It'll be ignored, but that would be the accounting treatment. I think we probably better end. We've got a few seconds. Catherine, does that sound good to you?
Yes, and I think if we did not get to your question, we will be emailing you your answer after the webinar. So don't worry if Donna didn't have the opportunity to answer your question, we will reach out to you. You will be receiving your evaluation via email from Lara to complete for attending this course. And if you have any other questions, you can send them to Jonna via the information she left at the end. And we will be sending out copies of the presentation to all attendees. So thank you again for joining today. We appreciate your time, and we look forward to seeing you at the next B&B webinar. Thank you so much.